to create and grow income streams and manage, multiply, and protect your wealth in the new economy. Are you tired of trading your time for money? Do you desire freedom today instead of retirement in 10, 20, or 30 years? I'm MC Laubscher, and this is the Cashflow Ninja.
Hello Cashflow Ninjas, MC Laubscher here, and welcome to another episode of the Cashflow Ninja. I have another great show for you today. In today's show, we're going to look at the life settlements, an asset class that's not correlated to the markets and the economy in turbulent times that we find ourselves in. It's great to look at options, at asset classes that provide great safe havens and returns regardless of the economy and the stock markets. Joining me is Kevin Nichols from Penumbra Solutions. Kevin, always great to see you.
Great to be with you, MC. Thank you.
Now, for our listeners, if this is the first time that you've heard of this, of life settlements and of Kevin, go to cashflowninja.com and go to the search box and just type in life settlements or Kevin Nichols. There's a couple of other interviews that I've done with Kevin where we really deep dive into this asset class, exactly what it is, how it works, and how folks can actually participate in these vehicles these days, because there's different ways of doing it in this particular asset class. Kevin, for listeners that's not familiar with you and what you do, can you please share a little bit about your background and journey with them?
Sure. Our background is financial planners. Both my partner, Jim Walsh, and I were financial planners. And about 11 or 12 years ago, we used to invest in what were known as fractionalized life settlements, which was, I'll explain here in a minute, but it was an investment that was based upon people selling a life insurance policy. And we were both investors. We both had a great success with it. We had clients that were invested in it. We had family members, etc. And we were literally on the golf course one day, and I said, wouldn't it be a good idea if we could pool all of our investments? If I have a policy that I have to make a premium payment on, and then you get a policy that pays you, it would smooth out the yield, the return. And so we thought, well, let's look into it. And so we did, and son of a gun if we couldn't do it. So we did it. We spent about 18 months writing and getting attorneys to approve our memorandum of private placement. And after that, we went to market. My dad was our first investor. We had great success with it. And then literally in the second year, we had no time for anything other than the fund. We knew that advisors would want to use the fund for their clients, just like we were using it for our clients. And so we made sure that we could never touch anybody's money. We knew that people were going to want to invest in this without ever having met us. And even though we encourage people, if you ever come to Dallas or Fort Worth, please come see us. We'd love to show you around. So we don't ever touch the money. We don't ever even have access to the money. We use a third-party custodian. We use Bank of Utah as a third-party custodian. And what we do is we buy life insurance policies from senior citizens who are very old. The average age of the insureds of the policies that we purchase is somewhere between, well, let's say it's about 91 years old. Now, we don't go looking for them. They have representation from brokers, from attorneys, etc., and they raise their hand and say, hey, I can't afford this anymore. I need some money. And so we buy the policy from them. Frequently, we'll give them some of the death benefit they can retain for final expenses. But essentially, we buy the whole policy from them. We then continue to make the premium payments on the policy. And when they pass, we collect the death benefit. Because we focus on people who are over 90 years old, we don't have to worry so much about their health conditions. There are other life settlement companies who do what we do in the same space, and they'll buy a policy from someone anywhere from 72 to 85 years old. And that's good because the premiums are less. However, for our purposes, when you do that, you have to then get a medically underwritten life expectancy estimate. And frequently, more than 2/3 of the time, those are wrong, and they're wrong on the low side. So what happens is you have policies that all of a sudden become unprofitable.
The 1% grow their business and investments every year, regardless of the economy and marketplace, and pay very little or no taxes legally. Besides having the right mindset, elite strategies and tactics, and the counsel of elite wealth advisors, coaches, and mentors, they have access to opportunities that the rest of the population do not. If you're an accredited investor, we have a network that provides Cashflow Ninja listeners access to exclusive business and investment opportunities. To join our Investors Network, please apply at CashflowNinjaInvestorsNetwork.com. That's CashflowNinjaInvestorsNetwork.com.
And you have to sell them quickly. What we learned in about our second fund was, if we just focus on age, how long will a perfectly healthy 92-year-old live? And believe it or not, there are statistics that tell us that both the CDC, their actuarial tables, the valuation basic tables, which are put out by the insurance industry, they have a huge actuarial database. And so we have numbers so we can average where we think these people are going to pass. And that helps us in our buying decisions. That also helps us in knowing how long we're going to have to reserve premiums for going forward. So in a sense, that's really all we do. People invest their money. It's a pooled investment. It's very simple, very, very low fees. We charge 1.5% of an investor's fee up front. And then we get a 2.5% payment on the back end, a management fee, kind of a pay for performance fee. And that's it. There's no ongoing fees, no recurring fees. We don't do anything. Remember, our first investment was my dad. And there is no way I'm going to get that call from him telling me, what's this charge that you guys charge the fund? There's no way I ever want that. We also invest right alongside every investor. And so the fees are absolutely as minimal as they can possibly be. We don't ever touch a client's money. We've never had a policy not pay or pay less than what we thought. And we've never had a client lose a single dime. So we're pretty proud of that. And this is we'll be going into our 10th fund here in the next 3 months or so. Right now, we've still got a fund open, number 9, but 10 will be opening shortly.
There's a lot of misunderstanding around this asset class, right? I think it would be great if you can explain the benefits of why people would sell a policy to you guys. Maybe if you want to touch on that a little bit, what's the benefit to the seller in this case?
When you say you've got a $5 million policy for grandma and she's 92 years old, or say 90 years old, the premiums at that level are going to be very expensive. And so often, almost always, there's no cash value in these policies because they were originally a term policy that has been converted to a universal life. Of course, the benefit of universal life being that it's guaranteed renewable at a certain price, but we know exactly what the price is going to be going forward. So they don't have any cash value in the policy, and it's worth something. And so they'll go to market, they'll have a representative, whether it's an attorney or a broker or an agent, and they'll shop it around. They bring them to us. We don't ever go to a buyer directly. We always maintain an arm's length. And they'll say, hey, I can't afford this anymore. What's it worth? And so we'll give them cash. We always give them cash. Sometimes they'll ask us, can you just pick up the premium payments and give me a portion of the death benefit? We don't do that. We always make sure that they have some compensation up front. But we will give them a piece of the death benefit if it makes sense for us and depending on what they need. So, a lot of these people, they have, going back to 2008, they lost a lot of money in the market. I would imagine, hopefully, most of them were out of the market here in the last week or so. But that's generally the reason. For estate planning purposes, it works beautifully.
Yeah. Yeah, one of the things that when I was researching this too and learning more about it was just interesting to see that, almost 4 to 5 times more money than the cash value in their policy they were paid out for these policies.
Yeah. So this is a great
asset that can be sold for
liquidity to live out the remaining years of their life comfortably. So I could definitely see the value there in an event where they would just let it lapse, right? Because it becomes
affordable, so they would just let it go.
Well, now they have an option. Yeah, there's not a lot of cash value in there, but they can at least sell it for 4 to 5 times the amount of cash value that's in there. So there's a benefit for them, and then there's obviously a benefit for the buyer of it in that case. Here might be another question that listeners and viewers have. How is this legal? When did this become legal?
Yeah, this goes back to 1911. There was a physician who had a patient who needed a surgery, and the patient didn't have any money. And so he approached the physician and said, I have this life insurance policy that's going to pay off. It's paid up. Would you take that in exchange? And the name of the case was Grigsby versus Russell. And so the physician agreed that he would take it. And he performed the surgery. And several years later, when the patient passed, the physician presented the policy to the life insurance company, and they said, no, we're not paying on it because you didn't have an insurable interest in it. So he sued and went all the way to the Supreme Court. And at the Supreme Court level, none other than Oliver Wendell Holmes wrote the opinion that said, if you have a life insurance policy, it is in fact your personal property. You can do whatever you want with it. Furthermore, insurable interest only applies for the first 2 years during the contestability period. After that, it is absolutely in force, and it must be paid as long as the premiums are paid. So, and that goes back well over 100 years. It's been tested many times, and it still remains the law of the land. Berkshire Hathaway and Warren Buffett both heavily invest in life insurance policies in life settlements. I could list the name of who's who on the top.
Bill Gates, right?
Bill Gates invests a lot. Yes, a lot of institutions invest a lot of money in it. So yeah, it's not typically something that has been available to the average investor, and that was one of the reasons that we brought our product to market. Was we wanted it to be available to the small guy. It's not exactly available to the small guy still. You do need to be an accredited investor, or at least to be a knowledgeable, and this needs to be a suitable investment for you. So we don't want your last $100,000. That's probably not going to be somebody we would accept into the fund. But if it's suitable for you, absolutely.
Yeah. You bring up a great point there too about institutions, because this was for institutions. So a lot of life insurance companies, a lot of financial institutions, this is stuff that they put their money into
because of the contractual agreement that's based into
these insurance contracts.
Since 1845, no American B+ or better rated life insurance companies ever failed to make a payment on a death benefit. Now, we buy A to A- or A+ paper or from those companies. So in terms of the guarantee of who's going to pay, it's absolutely in stone. You're talking about financial institutions. American life insurance companies are literally stronger than most countries. They've never failed. You've never had a policy not pay. Furthermore, if there were, in fact, a scenario where a life insurance company could not pay, and the state's insurance board didn't have sufficient money to do this, then the legal reserve system for life insurance companies would come into play. We have legal reserve for banks, and that comes into play whenever banks are, illiquid. And how often has that happened in the last 20 years? Hundreds of times. In the last well over 100 years, it's never happened that a legal reserve life insurance company has ever had to tap into that fund, because they self-regulate and because they're so profitable. I could go on and on and on about why they're so profitable, but at the end of the day, you don't have to worry.
MC Laubscher, the creator of the Cashflow Ninja and Cashflow Coach at Producers Wealth, where we help our clients integrate infinite banking with their business and investments. To learn how you can create your own banking system to turbocharge your investments and business in 30 days or less, go to yourownbankingsystem.com. That's yourownbankingsystem.com.
We're talking about companies that have survived the Great Depression. Every stock market crash. It's not a problem. Here's the thing: if a bank, if you deposit $100,000 in a bank, based on fractionalized banking, the bank only has to have roughly 10% or $10,000. That's all they have to keep. The rest they can loan out.
Yeah.
If you buy a $100,000 life insurance policy from an insurance company, how much do they have to have on hand? Every single penny, $100,000.
Yep.
So there's no way that these are going to go backwards. It's just not going to happen. Now, could it happen? Sure, anything can happen. Will it happen? I don't think so.
Yeah, and that's why, as you mentioned, you have to look at the carrier of the policies, and you look at some of the, especially the mutuals in the United States.
It's just incredible that they've been around
since the mid 1800s. I mean, most of these companies have paid dividends consecutively for over 100 years. It's very,
very solid institutions. Any
company that's been around for over 200 years and been profitable
there's something to be said for that.
Here's an interesting thought. Side note: we were talking about Buffett, about Berkshire Hathaway, Gates. The largest investor in life insurance companies, in life settlements rather, the company that's buying more than any is AIG. They're an insurance company.
Yeah.
Now, they do it under another name, and I'm not going to tell you the name, but they actually buy more than anybody. What's that say? I mean, if you're an enormous life insurance company and you're out there, you're cherry picking up, other companies' life insurance policies, because these things have never missed. They've never not paid. So,
yeah. So that's
one of the clear benefits, is it's backed by the top-rated insurance carriers in the United States. One of the other things is, if I just look at it, I mean, it's not correlated to what's happening in the economy, recession, depression. It's not correlated to the stock market. I think the only thing that it's tied to is the contract is in U.S. dollars.
So there's some exposure there. What are
some of the other pros that people would look at something like this?
Well, it's what we tell people is this: it's not for all your money. It's only for the money you can't afford to lose. It's not a cash flow play. It's not. It's a growth play. If the average age of all the insured people in a fund is, say, 90 years old, we expect the fund will be completed in 8 to 10 years. So if you can't lock up your money for 5 to 6 years, don't do it. Now, we begin to pay usually in about year 5, year 4 to 5. The investors will start to see returns. There will be policies that mature before that, but those maturities are held by the bank, by Bank of Utah, and they're used to replenish the premium reserve account. Because, say, for example, we raise $10 million. We're going to only deploy roughly $6 million. We're going to hold back roughly $3.5 to $4 million, 35 to 40%. We're going to hold back in cash. We're going to take that $6 to $6.5 million, and we're going to go to market, and we're going to try and procure policies that are going to pay us in the range of $32 to $35 million. So $10 million fund, we're looking to receive roughly 3 to 3.2 times our money, even though we're only spending 60% of the 10 million to get there. And we've been able to accomplish that now for the last 5, 6 years in a row. That's pretty much where we're at. So if you have to figure, if my $100,000 investment, my $1 million investment is going to grow by 2.5 to 3 times over the next 7, 8 years, without having ever been exposed to market risk, having ever been exposed to the marketplace, without us ever having any access to their money, it's completely safe. You got to feel pretty good about it. And we do.
Yeah. One of the things that comes to mind is you've heard people say you make the money on the buy, right?
Yeah.
And this is a great example of that,
because essentially, if you're pulling the policies together, you're buying the equity up front. So you know
basically what the payouts will be
in any particular fund. Now the variable is the time, right? Until
the policies basically mature.
That's exactly it. We know what the high water mark is going to be. We know what it's going to be worth, and we buy it at a discount. And so we know when we close a fund, we raise X number of dollars, we know exactly what the high water mark is going to be, because we've already locked that in. We bought that What we don't know is when.
Yeah.
And that's where the age of the people in the fund comes, has a big factor. So, and that's why we focus on much older. Now, why doesn't everybody focus on older people? And there's a very simple reason. We're a small, kind of a boutique firm, and we have very, very low overhead. Now, if we were to, when I said originally, if we raise $10 million, we're going to hold back $3.5 to $4 million in reserves, 35 to 40%. That's a lot of money in our industry, a lot. Most companies only want to hold back 10 to 15%. Well, if you're buying policies where people are in their 85 or 88 to 92 years old, you can't do that. So what they do is they'll look for policies from people that are much younger, 65 to 72 to 75, 80, okay, in that range, because that way they can spend more money to buy policies, thereby generating income for themselves and not have to reserve as much money. So it's very simple. We don't have the overhead, so we can do this. It's very simply, and we like it this way.
Yeah, and this is the fund structure in one of our previous episodes. Again, check it out at cashflowninja.com. Just type in Life Settlements or Kevin Nichols or Penumbra Solutions. This is the fund structure. One of the other structures is, and this is what institutions do, is the direct investment in buying the particular policies. The fund gives you a nice overall diversification of policies that will mature at different times, that will add to some of the pros there too. What are some of the risks and the cons in an investment class such as this?
Biggest risk is cash flow risk. People we have a lot of clients who put the majority of their retirement savings in, and if something happens to them and they need to get out, it's difficult for us to get you out, because bear in mind, this is a private fund. It's a restricted security, so you can't just go sell this in the stock market. We have to find another buyer for your money, and generally there's going to be a discount. Someone's going to want a discount in order to buy your position out. So that's probably the main risk. The other risk is, of course, longevity. If people start living to 110, it's going to be hard to do better than 10, 12, 15%.
My friend Brian Page has created a cash flow machine generating over $100,000 in 6 months without owning any real estate. His system consists out of renting properties from property owners and renting them out on Airbnb. His system is so simplistic, it can be managed by virtual assistants, and yet so effective and powerful that it predictably generates cash flow every month. Brian and I are hosting a webinar where he shares his system and how it generated over $100,000 in 6 months for him personally. You can access this life-changing webinar at cashflowninja.com/BNB. This is one of the greatest cash flow opportunities I've seen since I've started my podcast. Again, the URL is cashflowninja.com/BNB.
How likely is that to happen? Given today's environment, I don't think very likely. Even though we as a society live longer every year, I think that is true for the last, I don't know how many years. It may have gone backwards a month or two last year. I don't recall exactly. The percentage of the population that lives beyond 95, 96 years old hasn't gone up in over 100 years. Yeah. We still don't have that fountain of youth. We can increase life up to that point, and we can increase its quality, but we still don't have the ability to find that fountain of youth where people are living that much longer. So, if we aren't, if a policy becomes unprofitable, we sell it, we unload it. Now we may sell it to another fund, one of our own funds, or we may sell it on the open market, and that's called a tertiary policy. In other words, one fund to another fund. We do a lot of business that way. So we're more of a tertiary buyer, where people have to sell because they didn't reserve enough money for the premiums. But we can be a tertiary seller as well.
Absolutely. Now, you've mentioned where it fits into a portfolio, that this is not a cash flow play.
It's more of a growth play. Money that
you cannot afford to lose outside of the markets. And one of the investment vehicles that there are some folks in my network that they utilize for this also is self-directed retirement funds, right? That's an option for folks to use that self-directed and then invest in something like this, and now you're not beholden to the Wall Street casino.
Exactly. Probably 85% of the money invested across all of our funds is qualified money, whether it's self-directed IRA, self-directed Roth IRA, solo 401ks, what have you. That is by and large the largest sector. I really like the Roth IRA play. If you've got a self-directed IRA and you can convert it to Roth and then invest it in the fund, or invest it in the fund prior to converting to Roth, sometimes we can get a discount when we value your investment because of the illiquidity, which would save you money in your taxes as you convert. But here's a beautiful thing. Take a $100,000 Roth IRA, okay? You set it into the fund and you go along and say you do, in 7 years, it's $250, and then you roll it again. Now you're 15 years into the thing and you're probably close to $500,000 or $600,000 that is now tax-free forever. They can't even tell you when to take it out. There's no place to report Roth gains or Roth withdrawals on a 1040 form. It's beautiful. I would say every one of your clients who, if you don't have a Roth, you need to find out how you can get a Roth or convert to Roth. But if you can do that, or you're interested in that, we wrote a good white paper on that, the benefits of Roth inside of our fund. So if any of your clients want that, just give us a call, or you can reach out to me either way.
Yeah, absolutely. Very interesting stuff. What are some other questions, most frequently asked questions that you get regarding this? I think we've covered in great detail what it is, how it works, the pros, the cons, where it fits into a portfolio, how to use it with self-directed stuff. What are some of the other things that might be of interest to listeners and viewers?
A lot of people, generally when people, once they understand it, they'll say, well, what's the B part? What am I missing? How come this seems too good to be true? And honestly, it's exactly as we represent it. If you don't have to have the money and you can afford to set it and forget about it, it's a very boring investment. Quite frankly, it is extremely boring. So some other things, questions we get, when we buy a policy, do we receive that money into the fund tax-free, considering it's a death benefit? And the answer is no, we don't. When somebody settles a policy, so say a senior citizen, they sell us the policy for cash, the money that we pay them, that they receive is I believe it's taxed. There's a basis for it, and I'm not a CPA. But if they retain a portion of the death benefit, say we got $1 million policy and they want to keep $100,000, that portion that goes to them is still tax-free. Okay, the $100,000 is tax-free. The $900 that comes to us is not tax-free. It comes to us and it's distributed directly from Bank of Utah into your account. If you've got a qualified account, it's going to be considered income and taxed as income. If you've got a cash investment account, it's going to be considered ordinary income. Now, if you have a Roth account, it's not taxed. There's no tax. It's completely tax-free. So how the money is taxed is one thing. We get a lot of, what if the insurance company wants to contest the policy? We only buy policies that are well beyond the contestability period. So they can't contest it. And if they do try to contest it when they know that it's beyond the contestability period, they get slapped on the hand, usually double or treble damages. It's not pretty. The state of New York did that, I want to say 2 or 3 years ago, to was it AXA? I'm not sure, but they got spanked very significantly for playing games. Let me think, what else, other questions? Those are probably the main questions. What's the main risk? Again, longevity. We want to make sure that we always have enough money in reserve to pay the premiums. That's why we reserve right off the bat 35 to 40% of whatever we raise, and whatever comes in the first 3 to 4 years goes to replenish that account, because keeping the policies in place without having them lapse, without having them even go into grace, is paramount, because that is our asset, and so we got to protect it.
Absolutely. Now, one habit I've observed from wealthy and successful people is that they're always studying and learning. What are you currently studying and learning?
Oh, my heavens. Man, you ask me this every single time. Every single time. I have, I've started writing actually. So I would probably feel better in our next interview telling you about some of the things that I've written and, essentially dealing with people, establishing trust, trying to be as genuine.
Life settlement investments have allowed financial and banking institutions to not only buy their equity contractually, but also diversify their capital from any economic, market, and geopolitical risk. It's been part of the billion-dollar blueprint followed by institutional investors. And if you're an accredited investor, you can also now participate in this vehicle with enormous growth potential. You can watch an informational webinar presented by one of the premier organizations providing life settlement investments, Penumbra Solutions, at cashflowninja.com/life settlements.
The nature of sales has changed so much in the last 20 years. My daughter went to work. I told both my daughters that at some point before they find their forever job, I want you to do two things. One, I want you to wait tables because I want you to see how it can be when people are at their worst. Two, I want you to work straight commission because then you're going to see how to really hustle. And so my daughter took a job selling cars and she was there about 6 months and did very well, but absolutely hated it. And I said, what is it about you? These people are so dishonest, and the fact that these guys were dinosaurs. People are educated now. They have everything at their fingertips. Yeah. You're not going to pull the wool over their eyes. They know the price of a car before they walk in. And it's the same thing in our business. So many people, they don't have one planner. They just don't. They have multiple planners, and whoever's got the best ideas. How can you present yourself, especially since most of us don't meet face-to-face with clients. I mean, we started our business. It was always on a face-to-face basis. And now people are accustomed to not dealing with advisors face-to-face, and it's more difficult. And so you really have to come clean with people. You have to let them see through you. For example, my partner and I, we've been together now about 12 years or so. I'm 60 years old. My wife and I have been married 33 years. We have 3 children. We live in the same house for the last 20 years. It's paid for. We're just like average Joe. We're just like you. My partner is the same way. He's got 5 kids. He and his wife have been married for close to 30 years. I know that. We're just regular people. We're trying to do the right thing for our clients. We put them first at every step.
Absolutely. Kevin, where can folks learn more about you? Where can they access the webinar that you guys offer to, and where can they get in touch if they want to learn more or explore any of these funds?
Absolutely. The easiest way to get started to learn is we have an online video presentation. It's 12 minutes long. They just need to go to www.thepennumbraplan.com. Penumbra spelled P-E-N as in Nancy, U-M as in Mary, B-R-A.com. Thepennumbraplan.com. It will ask for a password, and the password is Penumbra, all lowercase. It'll ask how they hear about us. Put your name in, okay? MC, put Cashflow Ninja, put MC Lobster, whatever. Or put MC Lobster. That's what a lot of people, they seem to think that's funny.
Pinchy the Lobster.
There you go. And it'll give them access. They can see that. And then from there, they can download, or if they want more information, contact us. Our contact information is all over that, but our phone number here is area code 817-479-9770. Again, 817-479-9770. My email address is kevin@penumbrasolutions.com. We are about 10 minutes to the west of the Dallas-Fort Worth Airport. We always welcome people to come in if they want to come and see our operation, how it works, how we do what we do, where the magic happens. We're more than happy to welcome you here and let you sit and talk as long as you want. Ask any questions you like. So
fantastic.
That's it.
Fantastic. Well, always a pleasure to speak with you. Thank you so
bet.
much for coming on the show and again providing so much value for my listeners. It's been a blast having you on again, my friend.
Absolutely, buddy. Really appreciate the opportunity to speak with your listeners, and we appreciate your friendship.
This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.